Good morning, everyone. This is Financial Literacy 101, and today we'll be breaking down call option and referencing the Greeks, most likely theta. And anytime you're thinking about option trading, this is the one Greek metric. This is the one Greek analysis that you absolutely need to understand. And we're going to deconstruct what theta is and how to apply it to your option trading. Let's get into it. All right, so understanding what theta is. Now, the term theta refers to the rate of decline in the value, okay? The rate of decline in the value of an option due to the passage of time. See, there's no time in which you can invest inside of a stock. Take, for instance, you guys start to invest in Tesla. You have 50 stocks of Tesla. There's no time. But when it comes to option trading, there's an expiration date. So there's a time of passage, meaning that that option can actually expire out of the money. So you spent $1,000, $2,000, $100, doesn't matter. There's a passage of time. Through that passage of time, that option can expire out of the money due to time decay. Due to time decay. I've talked about this before. Now, this means that an option loses value as time moves closer to its maturity date, also known as its expiration date, as long as everything is held constant. Now, theta is generally expressed as a negative number and can be thought of as an amount by which an option value declines every day. This is what we need to understand, and we're going to get into it because I have an option that is up $15, not too much, but most likely we need to look into the theta of it all. Bear with me here. So here's my option. I did a call option for $2, but this particular stock is currently at $3.15. So I'm in the plus. I'm at plus 15 at 12.50%. But here's my transaction. But let's look at the Greeks. And again, focus on the theta. We're not looking at delta. We're not looking at gamma, vega, or rho. Let's focus on the theta. Now, theta is part of the group that we see here called the Greeks, which are used in option pricing. Now, remember, options give the buyer the right to buy or sell an underlying asset at the strike price. The strike price is essentially your call or put price. Now, again, the strike price, which is also called an exercise price, is set when you first make the contract and when the first contract is written. And what this does, it informs the investor of the price at which the underlying asset, that's the stock, must reach before the option can be exercised. Now, the measure of theta quantifies the risk that time poses to option buyers, since options are only exercisable for a certain period of time. This is known as time decay. This is known as time decay, or the erosion of the value in option as time passes. Now, an option profitability decrease as time goes on. You can't make no money like that. But what happens when two options are similar, but one expires over a long period of time, the value of the longer term option is higher, since there is a greater chance or more that the option could move beyond the strike price. And as we look in here at the top, this option expires in August the 20th. So already I am nearing the break-even price, which is $3.20, but I'm already up $15, okay? Based upon the expiration date, according to the Greeks, and we're talking about theta. Now, because theta represents the risk of time and the loss of value of an option, stay with me, because theta represents the risk of time and the loss of value of an option, it is always expressed as a negative figure. It's always expressed as a negative figure. Now, the value of an option diminishes as time passes until the expiration date.
Oh, baby.
Since theta is always negative for long options, there will always be a zero time value when the option expires. This is why theta is a good thing for sellers, but not for buyers. And this is essentially why you guys should be buying long options. So you can have the right to sell when you start seeing a positive in value in cash flow within that option. Now, value decreases from the buyer side as time goes by, but increases for the seller, because you already bought the option. That's why selling an option is also known as a positive theta trade, as theta accelerates the seller's earnings on their options increase. Now, here's some special considerations that you might want to think about. If all else remains equal, the time decay causing an option to lose its intrinsic value as it approaches its expiration date, meaning you're losing money. Therefore, theta is one of the main Greeks that option buyers should worry about, since time works against long option holders. We must understand that. Theta, to me, is one of the most important Greeks, if not the most important Greek, to give me an indication, to give me an indicator of how my option will make money or expire out of the money. You can't make no money like that. Conversely, time decay is favorable to an investor who writes options. See, option writers benefit from time decay because the option writer becomes less valuable as the time to expirate approaches. Now, consequently, it is cheaper for option writers to buy back the option to close out the short position. Put a different way, option values, if applicable, compose of both extrinsic and intrinsic value. That's extrinsic and intrinsic value at option expiration. All that remains is intrinsic value, if any, because time is a significant part of extrinsic value, okay? Now, one of the main things that you guys probably looking at, what is the difference? Okay, theta versus all the other Greeks, Vega, Rho, Gamma, Delta. Now, the Greeks measure the sensitivity of option prices to their respective variables. You guys may hear people talk about option trading, and you guys, okay, call is I'm setting the strike price or the stock price at this number. And when it's reached that number, I'm gonna start to make money. Put, I'm setting the price point of that stock going down. And if that stock goes down to that price point and goes further down from that particular value, I start to make money. This is what we need to understand. Now, the Greeks measure the sensitivity of option prices to their respective variables. For instance, the delta of an option, okay, delta, that first one you see on the screen here, indicates the sensitivity of an option price in relation to a $1 change in the underlying security, that's the stock, while the gamma of an option indicates the sensitivity of an option's delta in relation to a $1 change in the underlying security. Vega indicates how an option in price theoretically changes for each 1 percentage point move in implied volatility. And you guys know me, I always talk about what? The implied volatility, which is a great indicator how this stock, this option will perform, whether it's going up or whether it's going down. So if you're looking at implied volatility, then you should also be looking at the Vega. So let's assume an investor purchases a call option with a stock price, also known as a strike price, of $11.50 for $5. $11.50 for $5. The underlying stock is trading at $11.25. The option has 5 days until expiration, and theta is at $1. So in theory, the value of the option drops $1 per day until it reaches the expiration date. Now, this is very unfavorable to the option holder. I have been a victim of time decay. I have been a victim of buying options too close to its expiration date, built upon risk, and also the Vega when I include implied volatility. I have lost more than I've won. I've won some, but I've lost more because essentially when we're looking at the mathematics of this, the Greeks is one of the most important analytical tools you can use to not only predict, but to basically tell you're going to make money from this. Now, assume the underlying stock remains at 11.25 and 2 days have passed. The option will be worth approximately about $3. Now, the only way the option becomes worth more than $5 again is if the price rises above 11.55, not 11.50. This will give the option at least $5 in intrinsic value, offsetting the loss due to theta or time decay. Ladies and gentlemen, this is the Greeks. This is theta. This is one of the most important analytical tools you can use when it comes to option trading. Because at the end of the day, if you don't understand the Greeks, you can't make no money like that. You will never make money from option trading. This is Financial Literacy 101. Learn money and be inspired. Good morning, Wanda Wisdom. I'm out.